Man Group is quite a unique company out there because its origins actually go back to 1783 when we were founded by James Mann, actually as a sugar cooperage and brokerage. Now we've actually been innovating over the centuries since then. So we've moved from commodities into investment management, and of course my speciality, which is bonds. But ultimately what we're trying to do is to really innovate across the asset classes, so really deliver unique return streams, unique products, which we think do differentiate ourselves from the competition. Talented investors join Man because ultimately we provide quite a collaborative and entrepreneurial culture. So what we aim to do is Man Group will provide the technology, the operational infrastructure, the trading, the risk management, compliance, distribution, and we just allow our talented investors, managers, and analysts to focus purely on generating alpha and finding value across the investment markets. Our approach to fixed income can be defined in 3 steps. So first of all, we're a very bottom-up focused manager. That means we really focus on company fundamentals and try to avoid big macroeconomic forecasts. We don't do that. So really we're looking for interesting companies across the entire investment grade, high yield, asset backed and emerging market universes. The second thing that differentiates us in terms of our process is really focusing on alpha, not beta. We are not benchmark huggers. We're very benchmark agnostic. Things like duration might be maintained at relatively neutral level to our indices, but ultimately we'll pivot our portfolios to where that corporate value, that company specific value actually is in markets. And then finally, we call it a small to medium sized approach. We tend to find more opportunities in smaller to medium sized bond issues outstanding. Now typically these companies are a bit more overlooked by some of the larger peers who focus on the biggest names in the benchmarks, and we often find very interesting value opportunities there. Well, I think the definition of a robust investment approach is that it should perform well in all types of market conditions, both the bull and the bear markets. And for us, it's about only investing when you're compensated for doing so. So that is adding risk when markets are cheapening up, and we're seeing a lot of perhaps panic from other investors in the marketplace. And that's when a value approach can really, in our view, add value to portfolios. But also there's times to be more defensive in your markets and focus on capital preservation when bond prices are quite expensive, and actually it's better to have a slightly lower beta to the overall market. So by pivoting between offense and defense, we think we can add value to portfolios. I would say, firstly, I mentioned it before, but we are not benchmark huggers at all. So we're very much focused on pivoting away from the overcrowded trades in the wider environment. We don't focus on trying to predict GDP numbers or exactly where rates are going to go or currency variables. We leave that to others with a more top-down approach, and we just focus to what we believe is our bread and butter, what we're good at, and that's fundamental stock picking.